Hi, this is Chris Kuflick, and I'd like to thank you in advance for taking a few minutes out of your time to understand how you can better perform the markets. Can you relate to this feeling? The company fundamentals look great. All the analysts love the stock, but it just keeps going down. Have you ever bought a stock in a good company and felt puzzled when the stock went down? How do you currently manage risk? In the next few slides and over the next few minutes, I'd like to show you how it is that we do this. This is the 5-step process I use to manage risk in the market. First, I look at the market to determine whether it is supporting higher prices. If it is, then I move to the sectors and determine which sectors are supporting higher prices. From there, my inventory of stocks and ETFs or exchange-traded funds are determined by those deemed fundamentally sound and in strong sectors. Then, from that inventory, I choose those that are technically sound and controlled by demand. Finally, all the investments in your portfolio are updated each day so that I can see changes in the supply-demand relationship and can notify you to opportunities as well as potential problem areas. We stick to the KISS principle. Keep it simple, silly. In fact, were you to visualize my game plan, it would look a lot like the following. I'm going to use an analogy of football to illustrate a point. The diagram that you see on the left-hand side of the slide is an offensive football play. Think about it for a minute. If your team played offense 100% of the time, they would be marginal at best. It is the same way in the market. If you play offense 100% of the time, as most investors assume you must do, your investing and performance will also be marginal. In any football game, there are times where the offensive team will be on the field and times where the defensive team is on the field. The problem that most investors have is knowing which team should be on the field. Knowing when to play offense and when to play defense can make all the difference in meeting your goals, whatever they might be. History continues to repeat itself with steep declines in both the market and individual stocks. The key is where you get on the investment train. If you got on the investment train in 1929 in the US, it took you 25 years to get back to even. If you got on the investment train in 1973, once again in the US, it took you 7.6 years to get back to even. This is the same case for individual stocks. If you bought IBM in 1987 and wrote it down, it took you 10 years to recover those losses. If you bought BCE or Bell Canada, you have yet to recover. After the market casualty of 2008, how long will it take you to get back to even? Can you afford to go through another bear market? When we look at sectors, it is important to understand the basic law of supply and demand. We've all experienced these forces at the supermarket. We know why in winter tomatoes are expensive. We inherently understand why there are lemonade stands in the summer and hot chocolate stands in the winter. Stocks, sectors, and asset classes move in and out of favor, just like the produce in the supermarket. When we look at the causes of price movement in any individual stock, the market and the sector together on average cause 80% of the price movement in that stock. That means that company fundamentals usually account for less than 20% of a stock price's movement. This is the reason a company's stock price sometimes seems to move independently of the fundamentals. Most people, however, spend 80% of their time on stock evaluation and only 20% on sector and market evaluation. In other words, they ignore where the greatest amount of risk lies, the market and sector forces. Because most of the risk in any stock is in the market and sector, I structure my game plan from a top-down approach. Basically, there are two types of securities analysis: fundamental analysis and technical analysis. Fundamental analysis is what most of us are familiar with. When you see an analyst on TV or read comments from an analyst in a magazine or news story, most often these comments come from fundamental analysts. A fundamental analyst tries to answer the question of what to buy. He or she will study the company's balance sheet, evaluate the management team, and try to understand the quality of a company's earnings. A technical analyst tries to answer the question when to buy, and just as importantly, when to sell. A technical analyst wants to find the trend of a chart. Is it trending up or is it trending down? Is the stock outperforming the broader market? How high, or in some cases, how low can the stock go? Unfortunately, there are very few who effectively combine the fundamentals with the technicals. In a sense, they're playing piano with only one hand. While that may be a way to play a simple melody, you can play much better music if you play the piano with both hands. In fact, our game plan is grounded in this philosophy of combining the fundamentals with the technicals or playing the piano with both hands. In this slide, we see an original point and figure chart similar to those kept by Charles Dow. He was the first one to popularize this methodology. Dow was the founder of the Wall Street Journal, and he was a fundamentalist at heart, but he also appreciated understanding the supply and demand relationship in anything that he was going to buy. By putting the prices into a simple graph, Dow could tell several things about this stock. First, every time it rallied a little further than the last, telling us that demand was getting stronger. At the same time, each time it pulled back, it did not pull back quite as far as the previous time. That tells us that supply is getting weaker. This is what we want to see in a stock we own: demand getting strong and supply getting weaker. Notice also the formation in blue. Think back to geometry class and what does this look like? A square? A trapezoid? It looks like a triangle pattern. You've just read your first point and figure chart. There are 11 patterns in all, and the bullish triangle is one of them. The point and figure chart is merely a logical, sensible, and organized way of recording supply and demand in the marketplace. This is a modern-day point and figure chart of Deere. The numbers have moved to the vertical axis, and the prices have been replaced with X's and O's. X's represent demand, and O's represent supply. You'll notice that from September 2008 to December 2008, the stock was making lower X's and lower O's, meaning that demand was getting weaker and supply was getting stronger. That started to change in December. We now see that Deere is showing demand getting stronger by the X's going higher and the supply getting weaker by the O's not pulling back as far each time. You will also notice two lines, red and blue. The blue line is called the bearish resistance line. As long as the stock is below the blue line, its trend is negative. Conversely, the red line is the bullish support line. As long as the stock is above the red line, its trend is positive, and this is a possible candidate for investment. Now that you have an understanding of how the point and figure chart works, let's have a little test. Look at this chart. Is supply or demand in control? Clearly, supply is in control. If you had this stock in your portfolio, would you want it in there, or would you want to sell or hedge it? Do you know what this stock is? It was Citigroup in October 2007. The stock had clearly started establishing a series of lower X's, meaning that demand was getting weaker, and lower O's, meaning that despite the fact that the stock was moving lower, many fundamental analysts kept their buy recommendations. Above, you will note a quote from the New York Times. Please take a moment to read it. By early 2009, when the market had suffered its worst January and February since 1950, there were only 5.9% of stocks that had a sell rating. This is according to Bloomberg. If the fundamentals in this time frame did not warrant a sell ratings, when would